Hello, traders. Join me as we reflect on a principle that stands as a beacon of success: consistency. The importance of consistency in Forex trading cannot be overstated, for it is the steady hand that transforms fleeting wins into enduring profitability. It is the disciplined rhythm that aligns a trader's actions with their goals, fostering resilience and clarity amidst the volatility of pairs like euro to US dollar, cryptocurrencies, oil, or gold. By cultivating and leveraging consistency, traders can build robust systems, mitigate emotional turbulence, and achieve sustainable growth in their portfolios. Allow me to illuminate the profound impact of consistency on trading equities, gold, euro to US dollar, oil, cryptocurrencies, and US dollar to Canadian dollar, among others, while sharing detailed strategies to harness its power. Forging a deeper connection between your aspirations and the markets you navigate. Consistency in trading manifests as the deliberate repetition of well-defined processes, from strategy execution to risk management, ensuring that a trader's actions remain predictable and aligned with their objectives. Consider the trading of euro to US dollar, one of the most liquid currency pairs. A consistent trader adheres to a tested strategy, perhaps entering long positions when the 50-day moving average crosses above the 200-day, with a stop loss at 30 pips, regardless of short-term market noise or emotional impulses. This steadfast approach contrasts sharply with erratic trading, where decisions shift with every candlestick or news headline, often leading to losses. Consistency fosters a structured framework, enabling traders to evaluate performance objectively, refine strategies, and build confidence in their methods. Whether applied to the steady trends of US dollar to Canadian dollar or the volatile swings of oil. Emotional discipline, a critical facet of consistency, serves as a shield against the psychological pitfalls that plague Forex trading. Markets like gold, driven by geopolitical events or inflation fears, can evoke strong emotions, either during a sharp $50 drop or greed during a rapid rally. A consistent trader, however, remains anchored to their plan, avoiding impulsive trades that deviate from their risk-reward ratios. For instance, when trading equities alongside Forex, such as pairing a tech stock ETF with euro to US dollar, a consistent trader maintains uniform position sizing, perhaps risking 1% of their account per trade across both asset classes. This emotional steadiness prevents overtrading during euphoric bull runs or panic selling in bearish dips, preserving capital and fostering long-term growth across diverse markets. Risk management, the backbone of consistent trading, ensures that no single trade, whether in oil or US dollar to Canadian dollar, jeopardizes a trader's account. By consistently applying rules like a 1-to-2 risk-reward ratio or capping daily losses at 2% of capital, traders create a safety net that withstands market turbulence. Imagine trading oil, where prices can surge or plummet based on OPEC decisions. A consistent trader sets predefined stop losses, perhaps at $2 below entry on a crude oil CFD, and never risks more than their plan allows, even when tempted by a breakout. This disciplined approach contrasts with traders who adjust risk haphazardly, exposing themselves to catastrophic drawdowns. Over time, consistent risk management compounds small gains, turning modest profits in pairs like euro to US dollar into substantial portfolio growth. Consistency also enhances a trader's ability to adapt and refine strategies through systematic evaluation. When trading gold, a trader might use a trend-following strategy, entering trades based on MACD crossovers. By consistently documenting each trade's outcome, entry price, exit, and market conditions, they can analyze performance over 50 trades, identifying whether the strategy excels in trending markets or falters in consolidation. This data data-driven approach allows traders to tweak parameters, such as tightening stop losses on US dollar to Canadian dollar from 50 to 40 pips, without abandoning their core system. Unlike inconsistent traders who switch strategies impulsively after a few losses, consistent traders evolve methodically, ensuring their adaptations are grounded in evidence. Whether trading equities or Forex pairs. To leverage consistency effectively, traders must first establish a clear, repeatable trading plan tailored to their goals and lifestyle. For a trader focusing on euro to US dollar and equities, this plan might specify trading only during the London-New York session overlap, using a breakout strategy with a 20-pip stop loss and a 40-pip target. The plan should detail risk parameters, such as risking 1% per trade, and include criteria for trade selection, like entering US dollar to Canadian dollar only after a confirmed trendline break. By committing to this blueprint, traders create a roadmap that guides decisions across markets, reducing the temptation to chase erratic moves in oil or over-leverage on gold during a news-driven spike. Embracing automation and tools can further reinforce consistency, particularly for traders juggling multiple assets. Platforms like MetaTrader 5 allow traders to automate strategies, ensuring that entries and exits on euro to US dollar or oil adhere to predefined rules, even during emotional moments. For instance, a trader might code an expert advisor to buy gold when RSI exits oversold territory, with a fixed 1-to-3 risk-reward ratio. Journaling tools enable traders to log every US dollar to Canadian dollar or equities trade, tracking metrics like win rate and drawdown. These technologies act as guardrails, helping traders maintain consistency by removing discretion from execution and providing data to refine their approach. Building habits through small, consistent actions is another powerful strategy. Traders should start with manageable routines, such as reviewing economic calendars daily to anticipate events impacting euro to US dollar or oil. Practicing on a demo account for 30 days, executing 100 trades on US dollar to Canadian dollar with a fixed strategy builds muscle memory and confidence before risking real capital. Over time, these habits, whether backtesting a new equity strategy or setting alerts for gold support levels, become second nature, embedding consistency into a trader's workflow and mindset. Regardless of market conditions, continuous learning and community engagement amplify the benefits of consistency. Traders should dedicate time weekly to study market dynamics, such as how Fed rate hikes affect US dollar to Canadian dollar or how supply shocks drive oil prices. Joining Forex communities allows traders to share insights on euro to US dollar trends or gold breakouts, reinforcing disciplined habits through accountability. By consistently seeking knowledge and feedback, traders refine their edge, ensuring their systems remain robust across equities and Forex markets, among others. Finally, traders must cultivate patience, recognizing that consistency yields results over time, not overnight. A trader averaging 2% monthly returns on euro to US dollar through disciplined execution will, with compounding, far outperform one chasing 20% gains with erratic trades. Celebrating small milestones, such as sticking to a risk plan for 20 consecutive gold trades, builds momentum, reinforcing the value of steady progress. Patience transforms consistency from a daily task into a lifelong discipline, unlocking the full potential of markets like oil, US dollar to Canadian dollar, and equities. I sum up on this note: consistency is your greatest ally, a force that turns ambition into achievement. By crafting a clear plan, leveraging tools, building habits, and embracing learning, you can harness its power to navigate the complexities of euro to US dollar, Bitcoin, gold, oil, US dollar to Canadian dollar, and equities with confidence. Let consistency be the heartbeat of your trading, guiding you through volatility and toward lasting success. Thank you.